Let's talk money.
Hello and welcome. You're watching Let's Talk Money, the one-stop for all of your personal finance issues, questions and queries. Well, 31st of March is approaching and that income tax deadline is also drawing closer. This week, we are focusing on helping you with all that last-minute tax planning, any of those unanswered questions that you may still be wondering how to solve. Well, joining us to do this week on the show is Parizad Sirwalla, partner and country leader, Global Mobility Services Tax at KPMG India. Parizad, thank you so much for joining us on the show.
Thank
you know
you.
how it is. We keep talking about, keeping up with the calendar all through the year, but I'm sure there are lots of us who are still wondering if we've done everything we need to do with respect to saving tax. So welcome to the show, and let's open out with your thoughts, and you give so much of advice to people across different companies. So is this usually a last-minute rush season?
So thank you for having me over, Surabhi. And as you reminded me, it's March again, end of one more tax year, which is 23-24. Time really flies. Generally, hopefully, individuals should not clamor towards the end of the tax year and not wait for last but not the least types to, plan their tax matters. Hopefully, by now, we should true up our tax matters and be clear, because 15th March is already the last date for payment of our advance taxes. But it's never too late to sort of wind up, because, 31st March is the end of the fiscal year. But of course, last minute hygiene, hopefully you're aware of which tax regime you're falling in as an individual. There are so many slab rates, different tax rates for all of us as individual taxpayers. We are sorted by now on what deductions we've claimed, what investments we need to make, and last minute hygiene factors, if any. All our taxes need to be truly paid up. Balance sheet should be squared up. We are good to go, and that, let's say, end to the end of another tax year.
For a lot of salaried taxpayers, myself included, while there is the TDS that's always deducted, which is the case, but
Correct.
Usually there are these little tidbits here and there that we forget, we don't keep in mind. So before we get started with all the viewer questions, is there a rough checklist that you can share with us, which everybody should sort of keep in mind in terms of just pure housekeeping before the 31st?
So basically, for salaried taxpayers, which would be more or less, a lot of people falling in that category. Hopefully, you not really change your job during the year, but if you have, and many could fall in that category, then you need to be clear that all your appropriate slab rates and standard deduction has been claimed by one, during your one job tenure as well. Because you can't have a last minute situation where you have double deductions and you realize at the fag end of the year in March that, you've short paid on your taxes. So things like that usually happen. It could be your provident fund transfer, so on and so forth. But largely for most individual taxpayers, they generally scramble towards the end of the year to invest either in life insurance policies or last minute PPFs and provident funds to see how, that last bit of tax can be saved. But as I said earlier, by now you should know whether you're under the old tax regime or the new tax regime, which are the two optional regimes prevailing, and your liabilities should all be paid off or exemptions claimed, as the case may be.
Don't worry, in case you are one of those who are still scrambling to make last-minute tax-saving investments. We'll put out that checklist also for you in terms of what are your options. But, let's also get started with the viewer questions. We have Ananya joining in on the phone line. Ananya, I think, is calling us from Mumbai. Ananya, hi. Welcome to the show. What's your question?
Hi, my name is Ananya. I'm a 22-year-old college graduate. I have gotten my first job and I have no idea how to do my taxes. I'm going to be working at a software company and will be earning about 12 lakh rupees per year.
Okay, kind of reminds me about myself as well. For a lot of us, the whole journey towards investments or, any kind of financial planning started with your first salary and the need to save tax.
Right.
What would you tell her, Parizad?
So I would say, first of all, congratulations, Ananya, for your first job. Wish you the best of luck. As far as taxes are concerned, looking at your level of income, I think, again, there are certain break-even thresholds, at a 12 lakh income. If your deductions are roughly around in the range of, 2 to 3 lakhs per annum or more, then you may be better off under the old tax regime. But if I were to just talk of what we call commonly the Chapter 6A deductions, and you may be familiar by now, the bundle deduction under Section 80C, which is very popularly used by all of us. I mean, literally all your expenses and investments can come there. I mean, whether you invest in a provident fund or a PPF, or you take, if you have some, other investments which qualify there, fixed deposit interest, or a home loan if you've taken, all this typically fall under the 1,50,000 per annum 80C deduction is something that you can look at. With this kind of income, you might not have started donating, but there are certain eligible donations which can also avail certain tax reliefs. A lot of us these days are very worried about the spiraling medical cost. And if you are a person who started getting into health insurance for self and family, then there are certain annual insurance premium deductions under Section 80D, which you can also avail of. And at age 22, if you have, definitely you will have premiums paid for your parents. So a family floater policy, if you've taken and you're paying, then you can get, additional amounts for parents as well. So things like this, Chapter 6A deductions, couple of them, these days, young generation is a lot into electric cars. So, the government has prescribed an additional 1.5 lakhs per annum for, if you've bought an electric car, then you can avail that deduction as well. There's a new section carved out. Some of us have investments in NPS or the pension scheme. So there's an additional 50,000 deduction therein for employee contributions over and above the 1.5 lakh under the ATC crowded limit. So it all depends under which regime you're falling. And with this kind of income, if this is your investment appetite, then typically maybe you have to do the maths, but the old regime may be better
because it still offers this whole plethora of options under which, you can get deductions and
Yes, you have to do the arithmetic there to see where you fall.
All right, let's move on to another viewer question that's coming in. Prashant Nanda has written in this email, and he's saying his annual income is about 20 lakh rupees. And it's the same question, Parizad, old or new? It's interesting, right? The government wants everybody to move to the new regime, but a lot of people still want to cling to the old. Now, for someone like him, 20 lakhs is the annual income. I don't know if that's a taxable income or not, but ballpark.
Yeah.
What should someone be doing?
Yeah, so the stated intent of the government, if you saw last year also when this was introduced, it was very clearly said that going forward, unlike last year, the default regime is now going to be the new tax regime, which has got the most slabs and the lower tax rates, but devoid of any exemptions. But as of now, the option to go under the old, the new very much exists and prevails for individuals. With an income level of Prashant, and I roughly remember around 15.5 lakhs of taxable annual income, if your deductions that you're used to claiming, which we just described, depending on what you're investing and where you're spending on, if that's to the tune of annually for roughly 4,25,000 per annum, then you're break even. So any deduction or investments that you're doing above that, then you're better off under the old regime at that threshold of income.
So if you're, roughly speaking, if your taxable income is 15 lakhs,
and 15 lakhs, and your annual deductions that you're used to claiming,
which can be your deduction
all
of home
your
loan interest, ATC, medical
everything
insurance,
put
all
together,
of that.
4.25 lakhs roughly. On an annual basis. If your deductions are exceeding 4.25 lakhs, then you may be better off in the old tax regime.
Okay.
There's no magical formula. You have to actually sit with your individual case and look at the maths, as I said, and see. But
you can switch, right? I mean, there is
salary taxpayers can. They can.
And if you opted for one particular regime at the start of the year with your employer, but by the end of the year you feel that you want to switch, can you do that?
Yes, provided you don't have income from business. So all salary taxpayers can definitely exercise that option to, even do a flip-flop once they realize. But if you have business income, you can do it only once.
Got it. Yeah. All right. Well, that answers some questions. We have many more coming in from our viewers. But first, a very, very quick break. We'll come back and keep talking taxes on the other side.
Let's talk money.
Welcome Welcome back. You're with us on this week's edition of Let's Talk Money, and we're making sure that your taxes are in order before we hit the 31st of March. A lot of you have been writing with questions, old regime, new regime, what savings, what deductions. So let's keep the flow going. We have Pratap Jain now joining in, and he's joining us on Zoom. So let's quickly listen to his question. Pratap, great to have you on. Tell us, what's your question?
How to reduce my CTC, because right now it's above 50 lakhs, and that means I'll have to pay the additional surcharge and cess. So is there a way to contribute, of course, legally to non-profit organizations or organizations that give relief under Section 80G to reduce my overall income? Because I would rather donate money to a noble cause than pay tax to the government. But at the same time, I don't want my monthly take home to change much.
Okay, all right. Interesting question there. And, quite a nice trade-off. He's saying, I'd rather pay money to charity than to pay more taxes. And I think this is something a lot of people are grappling with, right? Because the moment your taxable income hits 50 lakhs, that's when the surcharge kicks in.
So Pratap, definitely at a threshold level of 50 lakhs of income, that's where the first surcharge kicks in. And to your specific question, there is a Section 80G wherein you can make certain eligible donations to certain funds which are prescribed. There are rules prescribed. This section has always been in vogue. Certain charities that you do are eligible for 100% tax deduction. Certain charities are eligible for 50% tax deduction. And certain donations are also having within that a qualifying limit. So, for instance,
you can't donate endlessly.
So
and
let's
hope
say
to get
you
a
donate
reduction.
100 rupees. Not all funds, the deduction starts on 100% of 100 or 50% of 100, which is the amount you donate. There are also certain charities to which you give where there are qualifying limits, which means it's only up to 10% of your adjusted income, and there is a way to calculate that. So you can definitely donate. There is a list of prescribed funds. Most of the government funds and government charitable organizations would fall under the 100 or 50% deductions without any qualifying limits. Most of the private causes that we donate to, so please see the list.
And where do we get this?
It's generally notified by way of notification. There are circulars every year. Or the organization where you're donating, they come out with an 80G certificate, so they'll very clearly tell you where you are. But, whatever you donate, if it's an eligible charity, you will definitely be able to offset some amount from your taxable income. Again, then it depends on the amount you want to, donate to.
I think that's a great point. That, first of all, ask the question, whoever you're donating to, whichever NGO or charity, as to what is the deduction that you can claim. They will have that clarity.
Yeah, and please make the donations in check payments.
Absolutely.
That's very clear.
Yeah, absolutely. Check or digital, nothing in cash.
Yeah, absolutely. Nothing in cash. Yeah.
Got that. One more sort of query, and this is, we have, I think, Jaswinder on the line. Yeah, we have Jaswinder joining in. He also has a tax question. Jaswinder, great to have you on the show. So tell us, what's the question?
My name is Jaswinder, and I work in a financial regulator. My query is basically that my income is close to 50 lakhs. And my query is that I have about 15% of my investments in fixed deposit. This includes my emergency fund as well. So this generally I don't tinker with. So this 15%. My query is that since this 15% of my fund is in FDs, this will earn some interest. And because of this, my income will surpass 50 lakhs. And once it crosses 50 lakhs, there is an additional surcharge of 10%. That is around 1.5 lakhs that I'll have to bear. So what I was thinking is that can I move this 15% from FDs to a debt mutual fund and pay that expense ratios while compromising on safety, since it is my emergency fund as well. So I need an answer on that.
Okay, how similar, right? Jaswinder, thanks so much for calling in. And even the previous caller had a similar question. How do we not hit the threshold where surcharge kicks in? And one can understand, right? Because it becomes painful. The pinch is that much more, 10% surcharge the moment you cross 50. Now, he's saying instead of letting that money sit in fixed deposits and that interest income is added to your taxable income, is it better to put it in debt mutual funds?
So Jaswinder, I'm going to just mention on the tax part of it, you know, because a lot of investment planning is also investment, other commercial, financial considerations. But purely from a tax point of view, yes, we know above a 50 lakh threshold, there's a surcharge. Now, fixed deposit interest is taxable and there's really no deduction for interest on fixed deposit, which can offset your taxable income. Your question was on debt mutual funds. So, subject to the other overall yield and other, analysis that you've done, debt mutual funds, as I understand in the market, are either dividend debt mutual funds or growth debt mutual funds. Please check with your financial planner before you invest, because if it's yielding dividend income, then that's also clearly taxable. But if it's a growth option, which means it's just plowing back the funds, then yes, to that extent, your interest on fixed deposit will not be there on an annual basis, which may lower your 50 lakh. But of course, as and when you get the funds from the debt mutual fund, at that stage, your level of income will be higher, or when you liquidate.
So basically, this is like deferring your tax liability till the time you decide to sell those funds, and that's when the capital gains will kick in.
So it should also be a function of your other financial investment, commercial considerations along with your risk appetite.
Okay, so got that. I think those are great points. Some different ways in which you can try and see if you don't breach that surcharge threshold, ATG, the donations as she mentioned, and perhaps debt funds, but subject to what your investment advisor is telling you. Parizad, before we sort of wind up, I have some questions of my own as well. One is that this was the financial year where a couple of new things kicked in. This higher TCS, 20% tax collected at source when you're making payments above a certain threshold overseas. That was one. And then the way life insurance policies are getting taxed, that also changed. Again, there were some thresholds over there. So can you just revise that for us and what all people should keep in mind?
So last year there was this huge amount of anxiety, as you said, around the TCS, which is under the liberalized remittance scheme. So any remittance that you make as a resident outside India, other than for specified purposes of education or medical, the rate of TCS, like you have TDS, which is a prepaid tax, TCS, the rates increase dramatically from 5% to 20%. But it's just like a prepaid tax. So it's agreed it's a cash flow issue, but when you're computing your annual tax liability, or even when you're computing your advance tax quarterly installments, you can offset that 20% even if it's collected at source. It may be a timing issue, but like you would offset your TDS, and your net resultant tax liability is what you would pay taxes on.
So let me take an example. Suppose I took that foreign holiday or made some big purchases above the threshold, which I think was 7 lakhs. Above that, if you're taking two packages.
So if 20% was collected at source, it's simple like TDS. You'll have it reflected in your AIS, TIS statements. And when you're calculating your gross tax liability, you can subtract that.
There'll be a set off.
Yes, there'll be a set off.
Okay, great. So at some point, it'll all add up and I won't end up paying more taxes. What about insurance?
Your next question was on life insurance policy. So there was a change last year. First of all, the change was only for policies taken after April 23, not the previous policies. And the change was for any maturity proceeds not on debt. So any sum that you receive on debt continues to be exempt. But other than debt, if the premiums were exceeding 5 lakhs, then that would become taxable as income from other sources, which was not there earlier. And for new policies taken after 1st April, and there were detailed guidelines issued. How do you calculate the aggregate premiums? What if you have more than one, life insurance policies? So there was a change. If you remember, in the back of the ULIP policies also, were subject to payment or premium thresholds of 2.5 lakhs, the maturity proceeds were made taxable.
So basically,
there was a significant change.
for ULIP policies, if the premium is more than 2.5 lakhs, the proceeds will be taxable.
Correct.
And on life insurance, pure life insurance policies?
Above 5 lakhs for policies taken after 1st April 23.
Proceeds will be taxable.
Yes.
Okay, got that. So those are some of the important sort of new tax issues that we had to deal with this year. So as we're summing up, Parizad, just once again, hygiene elements, what should one keep in mind when you're finally, sort of looking
so
at
for most of us who are salaried taxpayers, if you have, people mentioned CTC claims, HRA, LTA if you've not availed, just do your paperwork on time. All your reimbursements, depending on how your pay package is, please submit those relevant bills. Your employer will have deadlines. You can finish off those hygiene factors very easily. And, we are already, just a few days short of the end of the fiscal year. By now, you should know where you stand as far as your income position is. You ought to know what your tax liability is at a gross and a net level. Please pay off those taxes, and by the time the year will be over, and then your deadline for the tax return will be due sometime in July if you're an individual taxpayer.
And speaking of deadlines, advance tax?
Advance tax, as I said, it's 15th March.
Okay.
Otherwise, you'll unnecessarily end up, depending on your situation, paying interest. And if you miss the 15 March deadline, please do not miss the 31st March.
And please remind us who all has to pay advance tax. I think pretty much everybody.
Anyone whose tax liability is more than 10,000 Indian rupees.
So, yeah, that covers like a wide universe.
Almost everyone.
All of us are under the ambit.
People having interest income, investment income, as the case may be. Yeah.
Okay. Very, very helpful, Parizad. I think this kind of sets us up, gives us, what we need to focus on. Really appreciate you being here and answering all of those questions so patiently.
Thank you. Happy tax filings. Thank you.
Thank you so much. Well, that's it on this week's edition of Let's Talk Money. Glad you could join in with your questions. Remember, you can keep emailing us on askcnbc-TV18@nw18.com or simply send your questions to any of our social media handles. See you on the show again next week.
Let's Talk Money